All right, let's dive right into this explainer and put UroGen Pharma on the operating table. We're putting on our expert investment analyst hats today, and we're taking this innovative biotech company and running it through the ultimate stock valuation gauntlet. We're going to apply the legendary frameworks of Warren Buffett, Benjamin Graham, and Peter Lynch, alongside rigorous discounted cash flow and alternative valuation models, just to see exactly what this stock is really worth. Here's our roadmap. We're going to look at a quick company snapshot, view the stock through the classic Buffett and Graham lenses, switch over to the Peter Lynch lens, run a DCF valuation model, check out some alternative models, and then wrap it all up with a final synthesis and recommendation. Let's get to work.
Section 1. UroGen Pharma Company Snapshot.
So, UroGen Pharma, ticker URGN. As of mid-July 2026, they're trading at $40.23. Giving this biotech innovator a market cap of almost $2 billion. They're a commercial-stage uro-oncology company, and they are heavily driven by this proprietary RT gel technology, which basically allows for sustained release of localized treatments. Now, looking at their Q1 2026 financials, they pulled in $50.96 million in total revenue. And get this, that actually beat analyst estimates of about $44.8 million. Gross profit, a stellar $46.82 million. But here's the catch. They're still operating at a net loss of $23.6 million for the quarter. That's negative 47 cents a share. They've got a decent cash cushion of $140.3 million, but a total shareholders deficit of negative $144.25 million. You're going to want to keep that deficit in mind because it's going to throw a massive wrench into some of our classic valuation models later on. Section 2. Buffett and Graham lenses. Let's see how traditional value investing handles early-stage biotech. Okay, looking through the Buffett lens, we have some strict criteria to evaluate. Economic moat? Absolutely. They just secured U.S. patent protection for their RT gel tech and their key drugs out to July and December 2044. That's an incredible monopoly. But the rest of the list? Oof. Consistent earnings? Nope. High return on equity? No way. Equity is severely negative. Manageable debt? They just took on a $200 million loan at a steep 8.25% fixed rate, and owner earnings are decidedly negative. Since Buffett requires a margin of safety based on predictable cash flows, the Oracle of Omaha would definitely pass at this current price. Applying the Benjamin Graham lens paints a pretty similar picture. For his defensive investor checklist, they do have adequate size with that $1.96 billion market cap. But the financial condition? Super mixed. The $40 million in cash is nice, but that massive shareholder deficit is glaring. Zero earnings stability, no dividends, and we can't even calculate a price-to-earnings or price-to-book ratio because both earnings and book value are currently negative. Honestly, Graham might spin in his grave at this balance sheet. It completely fails the defensive investor checklist. So, here's the million-dollar question. Graham's famous intrinsic value formula relies on multiplying earnings per share by book value per share. When both of those metrics are negative, the formula literally breaks down. You just can't take the square root of a negative derived from these numbers here. So how on earth do we value it? Well, because traditional value models really struggle with negative equity biotech startups, we have to make a critical analyst assumption. If we look at consensus estimates for 2027, analysts actually think EPS will flip positive to $1.40. But even if we use that optimistic, forward-looking EPS just to generate a hypothetical intrinsic value, a classic value investor using Graham's methodology would demand a massive margin of safety. They'd be waiting for a trigger price way down in the 20s, and they'd need proof of positive equity before even thinking about taking a position. Moving on to Section 3, the Peter Lynch lens. Let's look at this through a growth-oriented framework. To Peter Lynch, UroGen isn't a broken value stock at all. It's a classic fast grower. We're talking about companies expanding 20 to 25% a year or more. And the data totally backs this up. In Q1 2026, revenue for their bladder cancer drug, Zuzudori, literally more than doubled quarter over quarter, helping push total revenues past $50 million. So UroGen fits right into two of Lynch's favorite buckets, the fast grower and the asset play. The hidden asset here, that RT gel technology, which had a wild 94.5% response rate in the Utopia trial for their upcoming drug. Now, to get the PEG ratio, price to earnings relative to growth, we have to make an assumption. If EPS rockets from negative 88 cents to a positive $1.40 next year, that implies massive triple-digit growth, making the forward PEG look incredibly attractive. Lynch usually likes low institutional ownership to find hidden gems, and UroGen is already covered by 8 major analysts. But even so, Lynch would probably rate this a speculative buy just based purely on their explosive commercial momentum and massive pipeline potential. Section 4. DCF Valuation Model. Let's crunch some numbers with a discounted cash flow. To build our base case DCF, we need some explicit assumptions. First, we forecast free cash flows all the way out to that newly secured 2044 patent cliff. Second, we assume a terminal value using the perpetual growth method to capture the company's value beyond that cliff. And third, we discount it all back to today. For a commercial stage biotech with single asset concentration risk and heavy debt, using a standard weighted average cost of capital, or WACC, of 10 to 12% is right on the money. And here's where the magic happens. Right in the center of our sensitivity table, if we assume an 11% WACC and a modest 3% terminal growth rate, our DCF fair value lands right around $45 a share. Since it's currently trading at $40.23, this quantitative model suggests the stock might actually be slightly undervalued right now. But, and this is a big but, that's only if management executes flawlessly on their commercial rollout and actually secures FDA approval for their pipeline.
Section 5. Alternative Valuation Models. Because normal multiples like price to earnings or EV to EBITDA just don't work with UroGen's net losses, we can use a comparable company analysis, focusing on enterprise value to revenue. Take a competitor like Oric Pharmaceuticals. They have a market cap over $1 billion but are totally pre-commercial. UroGen, meanwhile, just posted over $50 million in actual, concrete revenue in a single quarter. Based on forward estimates, UroGen trades at roughly an 8.5x EV to revenue multiple. Yes, it's a premium, but it's justified by actual accelerating sales, giving us a fair value range between $35 and $48, depending on peer comparisons.
We can also flip the script and run a reverse DCF. Instead of forecasting cash flows to find a price, we take today's $40.23 price and work backwards to see what growth rate the market expects. This tells us the market is already pricing in massive, sustained double-digit growth in free cash flow. Basically, the market has already fully baked in the success of their upcoming clinical trials and NDA submissions. The takeaway here? Any stumble or any slowdown in sales could severely punish this stock because perfection is already priced in.
Section 6. Synthesis and Recommendation. Let's bring this all together.
This master scorecard is the result of our analytical gauntlet. The classic value investors, Buffett and Graham, they'd pass entirely, waiting for a trigger price deep in the 20s and proof of positive equity. But Peter Lynch's framework screams speculative buy based on that hypergrowth. Meanwhile, our rigorous DCF model gives us a base case fair value of $45, and our comparables range sits comfortably right around today's price.
Ultimately, we're looking at a company at a fascinating inflection point. The key strength is undeniable, a staggering 94.5% clinical response rate and revenues that are quite literally doubling. But the risks? A $124 million shareholder deficit and $200 million in expensive debt. So as analysts, our final recommendation is a hold, or a speculative buy for aggressive growth investors at today's price. It's fairly valued assuming everything goes right, but there is absolutely no margin of safety for error. And hey, this is exactly why building a multi-model framework like this is so crucial. It exposes the blind spots and risks that a single model might just miss entirely.
Which leaves us with the ultimate question. You have to weigh the incredible, life-changing promise of their RTGL technology and an ironclad patent moat stretching to 2044 against the harsh reality of a $124 million hole on the balance sheet. So I'll leave you with this final provocative thought to ponder as you look at URGN's future. What do you prioritize more, the clinical promise of tomorrow or the balance sheet of today?